welcome to the conference. I'm very excited for the panel we have today. Very much a star-studded group of guests. And in the interest of time, I think we'll just jump straight into the discussion. Brandon, I'd love for you to be able to kick us off, provide some context for the audience about why we're here talking about energy markets. I know you work closely with power and gas markets, interacting with customers on a day-to-day basis. What do you feel is a fundamental shift that is different today from a couple years ago and something that real estate decision makers might not have fully appreciated yet?
All right, thanks, Faris. Good morning, everyone. Thanks for having me. I'm happy to be here on the panel with some esteemed colleagues here. So my position specifically is with Constellation, who is a natural gas and power retail marketer and supplier. So what I do is I help customers manage their energy procurement, help with strategies, kind of lay out the landscape, and really try not to delve too much into policy. I'm not going to give any hot takes. I'll leave that to Kevin and Amy because I'm from Boston. We have some customer events next weekend with a certain football game that I'm going to. So getting fired right now would be like the worst possible timing. So I'm really excited about the weekend. Anyway, so what's happening here is in the markets is things are changing. Obviously, we've heard about the energy transition, but it's happening from a supply standpoint and a demand standpoint, right? The supply standpoint, the grid mix is changing. It's more intermittent. We have more renewables, right? And that's a shift from the diversified fuel in the mix that we'd had before. And it's creating some gaps and some challenges to operate the grid more efficiently and reliably. And Kevin's going to talk about that more. But this shows up in kind of different markets in some as we transition some band-aids and some these markets and these policies create additional costs. So from the standpoint of an end user, we're seeing more of these costs show up in the electricity bill and natural gas bills, right? And so these are what we call non-energy costs. That's different from the wholesale market, right, that you pay for the production and generation of energy. And so understanding these non-energy costs, like the capacity market, right, sustainable mandates, especially in New York, very aggressive, right? And then some of these other ancillary services are really vital for if you're procuring energy and managing that risk. The introduction talked about how managing energy is a form of risk management, right? And we're starting to see more volatility in the market because of these changes, right? And so understanding what goes into that, what goes into your electricity bill and your natural gas bill, right? And how you formulate those contracts with your tenants, right? Are you transferring the risk to them, or are you providing that risk management to your tenants, and how you can and understand these different dynamics? I'm going to talk a little bit more later about what those customers, what you have control over. Some of this, is you don't have control over. You're kind of just rate takers, right? But there are different things that customers and real estate developers can do with their properties to manage the usage and how that impacts the cost you're paying. So I don't want to kind of run on too much, so I'll stop there, but we'll talk more about what customers can do a little bit.
For sure, we will. And you made a point there which I'd love to elaborate on, and Kevin, to bring you in here. When we talk about the grid, there's so much talk today about interconnection timelines and pressure on the grid and constraints. Can you sort of unpack what that means from a system operator perspective, and does that impact your job on a day-to-day basis?
Yeah, for sure. Interconnections are impacting our job, but then I think a lot of what the issues that Brandon just raised as well. So if I can, just for a second, maybe I'll just give a quick overview of what the independent system operator is and does. I usually ask this question: how many people think that they have a pretty good idea of what the New York independent system operator does? There's JP and Lauren. I know that. Okay, so not many hands. So I'll just take a quick moment. So we are and the professor in his remarks talked about having a grid operator here today. So that's what we do. We operate the high voltage electric system. So first major principle or responsibility we have is to reliability of that system. We are day by day, minute by minute, dispatching electrons from the more than 450 generators in New York onto the transmission system, making decisions where those electrons should go on that transmission system based on two elements. One, reliability, what's the most reliable solution, and two, what's the most economic solution. Delivering those electrons down to the distribution utilities so that they can do what they do. The second major responsibility we have is to operating the commodity markets. So this is where the energy or the electricity, the actual electricity that's consumed is bought and sold. And that's probably a big thing that we're going to talk about today and what just happened last week with energy prices. The third thing that we do is we plan for the reliability of the electric system on roughly a 5 to 10 year look ahead basis. So we have a lot of planning engineers. They're poring over loads of data that come in from various different sources, and they're trying to understand how the system is behaving and changing. Technology's changing it, investments are changing it, and where those investments to keep the system reliable on that 5 to 10 year frame are necessary. And so with all of that, what's happening on the system today? Let's talk about last week for just a second. We saw energy prices, electricity prices, in some cases, $750 to $1,000 a megawatt hour on the day-ahead market. Why is that? One, because there's greater demand on the system. We see that on a 5 to 10 year basis. Consumer demand is rising. Why? Because of electrification technology adoption and public policies that are pushing that, but then also, and we're going to talk about this, a lot of economic development that we haven't seen in generations here in New York, data centers, but also chip manufacturing. The second thing that caused those prices to be so high is that we've retired traditional thermal-based generation, especially here in New York. Old steamers that are inefficient and dirty. We retired about 1,250 megawatts of those starting in 2023, so there's less supply on the system. Third, the generation that we did have to rely on last week to make sure that we met the increasing demand on a moment-by-moment basis is old. It's aging. 50 to sometimes, there are units here in the city that are 70 years old. We're relying on those, and they cost more to run. Less supply, the aging supply that we're relying on more costs more to run. And then the fourth element is just the cost of natural gas. To fire those units, create the electrons that are being consumed, the cost of natural gas is up, not just here in New York, but across the country and certainly on a global basis. So we're seeing prices go up, and we're really concerned about the reliability of the system. Now I'll get to the interconnection, touch on that for a minute, and then we can move on, come back to some of these issues. So what do we do about these problems? What do we do about high prices? Well, we need to add supply. I mean, in simple, there's various different answers to that question, but the first is we need to add supply. We need to add cutting-edge technology that's costs less to run, is cleaner, it's more efficient for the customer, and more reliable. And as far as we're concerned, when we run those planning studies and we look at that 5 to 10 year time frame, we believe it's an all-the-above strategy. We want to add nuclear. It's very reliable, has high upfront costs, but on a long-term basis, it's less to run than some of those aging plants. Two, we want to add renewables because that gives us the emissions reductions that are required by public policies. And three, we want to add the cutting-edge, cleanest gas technology that's coming off of the assembly line by GE Vernova, for instance. That is dispatchable, meaning we can control it on a moment-by-moment basis, and it gives us those. It also helps us achieve, not entirely, but definitely measurably, emissions reduction. So we need to add supply. It needs to be coming a little bit of a cliche now, but that all-the-above resource strategy will help us achieve emissions reductions, make the system more reliable, and bring prices down.
Thank you for that, Kevin. And I feel you touched on a bunch of great points. But before we move on, I'd love to ask a follow-up to that. Before new supply is added, because presumably that's something that's not going to happen overnight, what's felt by consumers and developers on the other side of the meter in the meantime when we see these rising energy prices and demand is through the roof? How are prices affected? How am I going to see them, or how are utility payers going to see them?
Talk a little bit about the markets and try to not dive too deeply into the weeds, but we run 3 markets. Brandon mentioned the ancillary markets, so these are things like voltage support that keeps the grid reliable. 2, we have a capacity market, so we're compensating units to be there. We may not call on you, or we may call on you for just a few hours or a couple days out of the year, but we need to know that you're going to be there and produce those megawatts when the system's really stressed, like it was last week, or it was in June when we had a 4-day heat wave. And 3, we have the energy markets. And the energy markets is where we saw the price increases last week. But let's make sure we have it in context. The supply charge on the bill is roughly a third on the average retail customer's bill. The other 2/3, that's where the utility is embedding their costs and their profits, and then there's taxes and fees on that 2/3 of the bill. Of that 1/3, the actual commodity or electricity cost is determined by, 1, bilateral contracts and hedging that the utilities are required to do pursuant to the Public Service Commission requirements. So they're buying that electricity with that natural gas cost embedded in it long in advance of the kind of weather that we had last week. That helps smooth the price out, and it gives consumers, hopefully a levelized, lower cost. And then the markets that we administer and oversee, we can't control the price in that commodity market, but that's about a third of that total supply charge. So it's relatively small. However, when prices are $750 a megawatt hour on the day-ahead market, and then we have units that break down when we call on them, and they can't produce the megawatts that we've scheduled long in advance, we do have to go find replacement energy somewhere. And someone is going to end up paying that $750 charge. It does get embedded. So our retail customers across the state are going to open bills in 30 days, and it's going to be a shock. It will show up in their bills. And so these reliability issues, these investment issues, these public policy decisions do show up in the bill, and we have to take action now to make sure the system stays reliable and then reduce that supply charge.
Yeah, that's a great answer, and I think it's a pretty natural segue into something that I think most people expected to hear about when they think about energy markets and real estate is energy-intensive assets, namely data centers, which are all over the news and take up large amounts of power, something that's been putting pressure on the grid like previously never before. Amy, if you could give us some context here, what are data centers? Why are they taking up so much power, and why has it become such a headline throughout the year in 2025?
So I think just to contextualize it, we've been adding demand for data constantly, and many of us, if you had a blackout in your town or community, that like suddenly you can't use your credit card or you can't go to the bank and so forth. So those are cloud services. That's about 58% of the electricity demand coming from data centers. But the new wave in the last year or so is coming from AI workloads, which has roughly been in the last year or so about 13%. But projections are that that's going to rise to 28% of data center load by 2027. And there's a lot of hype. Wood Mackenzie Consultants says that there's 147 gigawatts of projects in discussion across the United States. That's a giant amount. That's 20% of national peak electricity demand. I mean, not all those centers will get built, but I think there's sort of the first layer is to make a distinction between you and I are going to the bank or someone's in Boston and using a Waymo, and those cloud services can't go down, and the fact that there's 7 or 8 companies in the United States that are dramatically competing to try to get to artificial general intelligence first. And that is something that I think is going to be debated more and more as we go forward, because that is what makes these mega data centers you've heard about, like Stargate and Meta's facility in Louisiana. We're talking about giant power load to reach something where the United States government has said is a major national security imperative, but there's a lot of disagreement about it. Those of you who have social media might have seen an announcement by Bernie Sanders last week saying that we should ban all construction of data centers going forward. I think that's not an educated view of what we need and what is more a competitive market, where we have some competitive goal, commercial goal that companies are trying to reach, and maybe we haven't had enough debate about how to allocate the land and the electricity for the national goal of AGI, as opposed to being captive to 7 or 8 companies trying to beat each other to that goal. So that's, I would say, point number one. But the impact on average Americans, is real, and witness. I mean, timely for us that New York just had to face that kind of situation. And there's some states in the country, New York is kind of lucky we're not in that same situation. New Jersey, I don't know how many people in the audience are from New Jersey. Electricity price increases in New Jersey have gone up more than 25% in the last 12 to 18 months. So, really substantial change, not on one bill, but in the average for the whole year. And then I like to point out that roughly 3 to 6 million households across the United States get disconnected every year because they can't pay their bill. And so I would like to throw out into the policy debate, not just the current debate we're having about, Kevin mentioned capacity markets, not just about how do we design capacity markets or reform them? Do we make it that the data center underwriters have to accept putting in extra generation to meet their own needs? And we can debate whether or not that would even be effective. But also, how do we set retail electricity prices in the United States? And are we doing it in the correct way in terms of balancing large load customers and retail customers, especially retail customers at the lower income level? And apparently, utilities are set that if a household pays more than 6% of its household income to energy, they're entitled to some kind of assistance. But, is that really the right metric when you're putting in a new large load like a chip manufacturer or data centers? Is that the right way to determine who pays and what share lower income Americans should pay? Given the high number of disconnections, I would argue that we need to actually rethink the pricing system and the classes of customers, and not just how we fast forward to connect generation as quickly as possible.
Yeah, I'm just going to jump in here. From a market perspective on the energy market, in downstate New York, there's like a 78% correlation between natural gas prices and the wholesale electricity prices in New York. And you might think, okay, well, that data center stuff, it's not really happening in New York. I think there's to a small degree some large loads coming on, but you might hear about Data Center Alley in Northern Virginia, Ohio, and Texas is developing a lot of these data centers, right? And what that means for you here in New York is, because of that reliance on natural gas, okay, when natural gas prices move up, then your prices and your electricity prices in New York are going to move up. So all the data center, and Professor Jaffe just talked about all the load that they're going to use, right? All these forecasts, we don't know what exactly that's going to be, but that load needs to be served by a fuel mix, a diversified fuel mix, but a lot of it's going to be natural gas. So you're going to need more, up to 10 to 20 billion cubic feet per day of natural gas. That's out of about 110 that we produce right now to power that. Additionally, coal plants are coming offline, right, and need to be replaced by natural gas plants. So that's going to also create this gap and this increased need of natural gas for the grid. And then throw on top of that, you've heard about LNG, liquefied natural gas. That's when you take natural gas that we produce from underground here in the US, you chill it, you liquefy it, and it's sending over to Europe and Asia, right? So that's about almost 20 billion cubic feet per day as well, right? And that's going to grow about 10 BCF a day more in, say, 5 years. So you have about potentially 20 to 30% more natural gas you need in the next 5 to 7 years, right? Can production keep up with that? Probably, but at the right price signals. So, if there's more demand than supply, then you're going to see prices move up, and that's going to create more volatility for your energy prices. So it's going to be like a rising tide lifting all boats. Even though, here there's not a big data center getting put right in downstate New York, but because of that reliance on natural gas in downstate New York, you're going to see more volatility, right? And then when you get a cold winter like this, everyone's using natural gas for space heating. That's when you see these blowouts. So last week, and Kevin talked about natural gas prices getting high. Last week, natural gas prices in the spot market for downstate New York was $140 per MMBTU, right? So right now on the NYMEX, when you look at CNBC, it's at $3.60. So $140. That was even more expensive than New England, who's they're at the end of the pipeline, which is typically the most expensive. So we're seeing these price spikes, right? And the ISO is trying to avoid this. We're running these ancillary markets, right? Flexible resources are needed, but again, this shows up in the cost stack, we call it, for the customers and electricity bill through these different components: energy, ancillary components. So, that's the real impact and kind of the shift when we talked about. I talked about the supply resource shift, right? Evolution. Well, the demand is also shifting.
Thank you for that, Brandon. Amy, if I could come back to you, you touched on a point that data centers and AI infrastructure, it's gone beyond just being an emerging technology, but it actually is a figure of national security and something that's transcended anything we thought it could be on a domestic scale, and it's a part of foreign policy, and often a rhetoric you hear in the news is this idea of winning the AI race and this new Cold War. What does that mean, and what would it be for the US to win the AI race?
So, it's a pretty complicated equation. I don't know if anybody, I can't remember the name of the movie. There's some movie where the world is divided between people who use robots instead of people and people who want to have a people-centric world. I don't know if anybody saw that movie. Not a great movie, but it's kind of like drew out the point that almost every technology you can think of that's coming that seems to be AI driven, that has, NVIDIA chips in the head of a robot or whatever it is, drones. Even just watching the Ukraine war, you can understand that we're moving towards what I call dual-use technologies. So if any of you have taken a Waymo or seen a Waymo, that technology came about because the Pentagon had a contest in the 2000s in the Mojave Desert, trying to get every young scientist in the world to try to come with $1 million if you could create a vehicle that could go over this race course in the desert. So, if you think about the role of drones and wars we've seen on TV, critical assets. And so all of these technologies, if you imagine that, Hyundai has invested in Boston Dynamics, which some of you might have seen their humanoid robot on 60 Minutes. Okay, well, they're planning to put that robot into factories to build cars. But you could imagine a future time when humanoid robots would do things that are weaponized, and you can imagine a future time, let me put it a different way. Written a book, Energy's Digital Future. There's a chapter on history, and why is that? Because the whole dynamic of what fuel we used in automobiles today was determined in the 1910s by World War I. And the fact that the United States government had to requisition the manufacturing plants of Ford Motor Company to make trucks to send to Europe because the Germans had control over the railroad system. And those trucks had to run on liquid fuel. So thinking ahead with these technologies and thinking ahead on manufacturing capability and whether manufacturing capability is either in the United States or in aligned countries, this whole question of AGI and intelligent robotics is a matter of national security in the sense that if there are other countries whose interests might in the future be hostile to the United States and they are ahead on that technology as a matter of warfare, that could be challenging. But I think as a society, you know, it's very hard for us. We have to step back from that. Even I and Carol Casada and others at the Center for Global Affairs that work on this issue, you still have to step back from that and talk about the guardrails that are needed in pursuing that technology, whether those are guardrails for what we allow the technology to do or not do in terms of privacy and safety, but also in terms of the data center question, because it just can't be that because companies are competing to be the first one there, we're going to have an electricity crisis in the United States. And you know, there are different ways to solve the problem. I mean, I get what we're saying about natural gas as the sort of obvious current solution to what peaking plants exist in the United States, but that really hasn't helped, like the area PJM, which has the most data center concentration. They have the most outages, even given the fact that they still have a lot of natural gas peaking. So it's not just that New York doesn't have enough natural gas supply. So there also is this question about what do we do in buildings, for example. That's why that makes this so timely for a real estate conference, because what is the building system for major buildings in New York City, and how do they run? How energy efficient are they? You know, what's required? What new technologies have come forth? You know, one of the big technologies that's moving forward is called circular buildings. So that's a building where the building itself generates its own electricity in some form or fashion. Some buildings are using geothermal heat and cooling underneath the ground. Some buildings are moving to AI-assisted HVAC systems. So with batteries to sort of change time of day usage away from peak, because we're all talking about what you have to pay to have electricity at the peak hours, not necessarily all day. So the real estate sector could be a major contributor to solving this problem, especially in a place like New York. So that's really why we have this panel, and why this panel is a critical part of sustainable real estate, is to really think through, you know, what contribution could the building sector make, and what does the building sector need to be motivated to move in that direction.
Thanks for that, Amy. It's a great point, and Kevin, if I can loop you back in here, you sort of touched on earlier that you're sort of waiting and encouraging the development of alternative power methods, whether that's renewables or nuclear. What have you seen that gives you encouragement that help is on the way, and what technology are you most excited about in the next few years?
So I probably should say we are a not-for-profit independent organization. And so when we run these planning studies and the data shows us what's necessary for investment, that's and to keep the system reliable, that's what we focus on. And then we have to take into consideration the public policies that are encouraging certain investments, certain technologies. But without getting into it, our framers 25 years ago wanted the organization to be independent so that we just followed the facts and the data. We were evidence-based, and whatever's good for reliability and the economics, that's what we pursue. So, but to your question, I think we get most excited about what is dispatchable, meaning what we can control that gives us that reliability attribute that's necessary to supply the growing economy and the increased forecasted demand. But we're also excited about what's going to satisfy the public policies. And certainly in the state, we have an aggressive set of climate and energy policies that want investment in wind, and behind-the-meter solar is where most of the progress this state has made in terms of investing in renewables, by the way. Utility-scale solar is still anemic, but behind-the-meter solar approaching 7,000 megawatts of capacity. And certainly battery storage as well. So it's really the all the above scenario, but if I could take a minute and just double back to interconnection, because that's also one of the responsibilities we have, is to oversee the interconnection process. So large loads, 10 megawatts or above, need to come to us, give us their designs, and we have to study that project on its own, but in the grand context of other projects that want to connect for reliability purposes. They cannot connect to the high voltage system, if those are their plans, without an interconnection agreement from us. So we run that study. On the other side of investment, generation, 50 megawatts and above, connecting to the high voltage system, we also have to study the reliability of that individually and collectively, give you an interconnection agreement. This takes a long time. We're trying to make it shorter. But to put the data center element into context, in June, we had about 4,000 megawatts of large loads in our interconnection process. These are projects that are lining up. They've got a seat. They're beginning the process. About approaching 2,000 megawatts of that total was the Micron chip manufacturing facility in Clay, New York, just outside of Syracuse. The other 2,000 in an assortment of things, including some data centers. By September, we had approaching 8,000 megawatts. That growth, all data centers. We're now above 11,000 megawatts of large loads looking to connect to the high voltage system. And yeah, those are all, that second level growth is also data centers. Brandon mentioned we don't have one in New York City yet. That's true. But we do have just above New York City some proposals upwards of 1,000 megawatts. They have site control, meaning they've got the land. So they're at 1,000 megawatts of data centers is enormous. I mean, the plot of land they have is big. And they have the node, meaning they know where they want to connect, and they have the financing. More and more, it's on us to figure out what's real and what's not, because we put these projects through strict scrutiny to understand, do they have financing, do they have site control, et cetera, so that we can do our job in terms of giving an interconnection agreements that they'll connect safely, but more so maybe is understanding, is that project real, so that we can then put it in our load forecast for the future? Because that means then collectively we have to invest in the system to accommodate that. Aside from all of this, we also are seeing the price go up. So that gives some context into the amount of growth that we're seeing in the technology, the large loads, and we are going to get to a point, if we are not adding resources, where there is just not enough capacity to accommodate these facilities. We are starting to see transmission capability in various different places, believe it or not, of upstate New York that cannot accommodate the local large load growth that seems to be there. So that's another burgeoning issue, and it crosses certainly with Brandon's set of assets and certainly the company's most recent acquisition of a number of gas plants.
Thanks, Kevin. And Brandon, on that note, when you're interacting with customers and asset managers, how are you finding that they're trying to manage energy risk? What are they doing?
Yeah, so I kind of want to circle back to what Professor Jaffe was talking about, is what can customers do, right? We talk about the supply side, the constraints, the challenges, right, and the additional load coming on. So what can you do here to help manage your costs, and then also, manage your supply. Resiliency, reliability are key. Those can be, leasing amenities to your to your tenants, right? And you want to show that value and differentiate yourself. So some of the things we were talking about is all these rates, right? You don't have a lot of control. There's some control you could do with that energy risk management through suppliers like Constellation, but there's some things you can do yourself, and that's, again, we talked about peak shaving, right? Installing battery, right? Battery energy storage, right? Demand response is really on the come, because instead of building new plants, new supply, well, just as good as reducing your demand, right? And you're operating like a reverse generator, right? So you can get paid these really expensive revenues that we're seeing in the day-ahead market that Kevin was referencing if you reduce your demand, right? And act like kind of a generator, So you're typically thinking about just using power and paying. Well, if you enroll in the demand response system, right, you're receiving those revenues. It's just like a perfect offset. So AI is a big part of demand response too, because it recognizes the patterns, right, and it uses algorithms and figures out when you should curtail, right? You want to curtail when prices are highest, right? Also behind the meter solar, right? What's behind the meter solar is doing actually is pushing the peak of the grid back into the evening hours, because during the sunlight, when everything's shining on 2 or 3, that used to be the peak in the summer, right? Well, because of behind the meter solar, right, you have less usage because it's netting out your usage lower, and it's pushing that peak down, and that peak impacts your capacity price, right? What you're paying for capacity. So there's a lot of things that customers can do. It's not hopeless and throw up your hands and say, rates are going higher. What can I do? Explore with. There's a lot of, hopefully you use Constellation, but a lot of suppliers out there. There's a lot of ESCOs that are providing this. That's part of the advantage of a deregulated competition state, where innovation is key, and you have to be innovative to stay ahead as suppliers in electric service companies. So take advantage of that. Have these conversations of what you can do, and bringing down that usage is really key and can help you mitigate those risks.
So before we jump to Q&A, I just want to point out, because you're all here as a guest here at NYU, and thanks to Schack Institute for hosting this, we have a new master's degree coming out starting next year. That's going to include a sustainable real estate track, but it will be a master's in sustainability and energy systems. And the idea is to train higher level students and returning professionals to be able to manage and understand some of these complex systems that we're going to have to put in place to really move forward, both in the real estate sector and in business and policy. So number one, Scantron out at the registration desk, if you're a student or someone who's wanting to upskill, Scantron to be notified. Applications open in March. But then also going to take sort of like a panelist prerogative and just ask Kevin to just quickly respond. The other thing we're doing is Sohail and I have been doing case studies. So again, there's a Scantron for our case studies on AI and building systems, and also on carbon content in building materials. We'll have more content coming out at Center on Global Affairs. We have a big program on virtual power plants, which Brandon is sort of referencing, which are these sort of systems where it could be a utility like Constellation, or it could be something called an aggregator, some kind of company that's going around and sort of piecing together or actually stimulating, thousands of batteries to work in unison at a time to manage peak demand and actually provide a secure hard asset. and not just a theoretical asset. Sometimes people say that demand response isn't really an asset, but if it's a battery and that battery is contracted at a certain percentage of the battery is contracted to be a supply source into a capacity or ancillary market, then it's a hard asset. So just asking Kevin to respond for a minute on, does the ISO, if these systems are behind the meter, does ISO have visibility in them, or you only have visibility in them if they're bidding into the capacity market? Like, how is that moving forward? How do you see that challenge and benefit moving forward?
Thought you were going to ask me to apply for the master's program.
Maybe to teach you.
So short answer is yes. And Brandon mentioned the behind-the-meter solar as well. So just a quick note on that. We have 2 peaks in the winter. So in the summer, you have one major peak. It typically happens between 4 and 8. In the winter, we have 2 peaks. So it's the ramp up in the morning. Everybody wakes up, they turn their furnaces on. You can watch it go from like 4 a.m. to 8 a.m. But then the second peak, and that's the most interesting one, happens after dark. And so imagine with the increased demand that I keep talking about in the future, people are getting home from work, they're plugging in their electric vehicles, they're turning on their heat pumps, they're turning on their lights, they're plugging in their phones, et cetera. That's where we see the increased peak going forward in the future in winter after dark. We don't have a system to accommodate that today. We barely were able to get through last week. To double back to the behind-the-meter solar, so in California, especially in the summer, their daytime peak is saturated by solar. They curtail it. They can't use all of it. So that's where the battery storage comes in. We don't have utility-scale solar here, as I mentioned, but the behind-the-meter solar is plentiful. We need batteries to help us get through that winter peak. That's the technology we're going to need in the future to get us through that winter peak when health and safety, with the weather still not warm today, is at stake. The second thing I'll say about the behind-the-meter solar is that we can see it. The control room operators see the amount of behind-the-meter solar, and they accommodate for that by backing off traditional fossil fuel generation. We got to wrap this up soon. So that's a good thing, right? Okay, if they see the behind-the-meter solar, we get technology in from NYSERDA and other software so that the control room operators can back down the fossil. So we can see that technology. We can see the amount that it provides. It did not give us anything Monday through Friday of last week because it snowed and it was really cold. And even when the sun was out, it did not move off of the solar panels. So that means, as I went back to before, we need a diverse resource mix of wind, solar, and that dispatchable technology that will show up when we need it, and health and safety is at stake.
Thanks, Kevin. I think we might have time for a quick question, or one question. So who is the lucky person that wants to ask a question?
Novice question. Ryu Kanishi, LaSalle Investment Management, real estate investment investor. If every building in an ideal world in New York City, state, upstate, downstate were able to become a grid interactive efficient building, right? Does the grid have the capacity to take all that energy?
Not now, currently, but
So what happens? Like, how do you build it out? How long does that take?
How long do we build out how long does it take to build out the grid?
Yeah, like in order to be able
Capacity
to,
that we need.
assuming there's a projected amount of how much energy could get generated from the built environment, right? Then what do you do, or how long does it take to build that infrastructure out?
Well, everything's capital intense, right? Of course. So traditional fossil generation that's coming off of the GE assembly line today is put your orders in now for 5 years. Brandon's side of the investment with nuclear, double that at least. And then, other capital intense retrofits in these large buildings also, and there's other people like Cecil who are much smarter on this than I am, who I encourage everybody to talk to, but also expensive, long lead times. The supply chain issues with all of this equipment, aside from the generating asset itself, phase angle regulators, copper, undersea cable, it is all long lead times, pinch points, very expensive. Inflation didn't help. The war in Ukraine didn't help because Europe is building out their systems so that they don't have to be reliant on a long-term basis on Gazprom anymore.
Just quickly, we didn't even really dive into transmission either, really, right? So you have to make sure everything gets interconnected, right? That has to get built out. You have the steel tariffs on that. Everything basically for infrastructure is steel, right? And we know about the tariffs. So there's another challenge.
Well, thank you very much. Please thank me in joining Thailand.